Have you ever wished you could lock in a price today for something you need in the future, knowing exactly what you will pay or receive, regardless of market fluctuations? A futures contract is obligatory because it is a legally binding agreement for two parties to buy or sell a specific underlying asset at a predetermined price on a future date. This means both sides are committed to the transaction, unlike an option contract, which gives the holder a right but not an obligation. This commitment is the fundamental characteristic defining its structure and purpose in financial markets. The core of this obligation lies in the contract design and the role of the clearinghouse. When you enter a futures contract, you are not just making a promise, you are entering a formal legal commitment. The clearinghouse acts as an intermediary, guaranteeing the performance of both sides of every contract. This significantly reduces counterparty risk, which is the chance that the other party will default on their agreement. To ensure this guarantee, participants must deposit an initial margin, a good faith deposit, and maintain a maintenance margin. If the market moves against a position, a margin call will requiring additional funds to be deposited to cover potential losses and ensure the ability to honor the contract. This continuous marking-to-market process ensures that obligations can always be met. For participants, fulfilling this obligation typically involves one of two actions before the expiration date. Most commonly, a position is offset, meaning the participant enters an opposite trade to cancel out the initial obligation. For example, if you initially bought a futures contract, you would sell an identical one to close your position. Less frequently, but still a crucial part of the contract's design, is physical delivery of the underlying asset or a cash settlement. This method depends on the specific futures contract and whether it is deliverable or cash settled. Understanding the obligatory nature of futures contracts provides significant value. It allows for efficient price discovery, enabling market participants to forecast future prices with greater certainty. It is a powerful tool for hedging, letting businesses and investors lock in prices to protect against adverse price movements. For example, a farmer can sell a futures contract to lock in a price for their crop before harvest. Additionally, it offers opportunities for speculation, where traders attempt to profit from anticipating future price changes. This structure provides predictability in an otherwise uncertain market environment. Ultimately, the firm commitment embedded in every futures contract, supported by robust clearing mechanisms and margin requirements, provides a reliable framework for managing risk and price exposure. It transforms an uncertain future into a manageable one, offering clarity and stability for those who understand and utilize these powerful financial instruments.